Chapter 3, Corporate Debt Securities. Video 5, Bond Yields. In this video, we'll be discussing bond yields and how to calculate them, the difference between yield to maturity and yield to call, and how yields compare between premium bonds and discount bonds. Yield to maturity is also called basis yield. It takes into consideration all the information found in the nominal and current yield and also assumes the bond is held until maturity. This means yield to maturity factors in gains on discount bonds, losses on premium bonds, reinvestment, and the time value of money. To figure out our basis yield, we need to first figure out the annual gain on a discount bond or the annual loss on a premium bond. Using this example, the $800 bond will have a $200 gain at maturity when the issuer pays the holder the par value of $1,000. If the bond matures in 10 years, the gain annualizes to $20 per year. So we now add that annualized gain to our annual interest of $80 with our 8% bond. This makes the numerator in our yield to basis equation $100. We then divide that $100 by the average of the maturity price and the purchase price. In our example, that is the average of $800 and $1,000. $1,800 divided by 2 gives us an average price of $900. So the yield to maturity on our 8% discount bond purchased at $800 would be 100 divided by 900, or 11.1%. Notice that for our discount bond, the yield to maturity, 11.1%, is greater than the current yield of 10%. Also remember that if we were doing the basis yield on our premium bond, we would subtract the annualized loss, and the yield to maturity would be less than the current yield. A little recap, because yield to maturity is a little more difficult. We need to consider the annual gain on a discount bond or the annual loss on a premium bond. With discount bonds, we will get more than we paid for it at maturity. With premium bonds, we will get less than we paid for it at maturity. Note that the formula for yield to call is the same, except the annualized premium or discount is spread over a shorter time period since it's based on the first call date. The first call date would shorten the time frame of the calculation because it happens before the maturity date. So, the assumption in yield to call is that the bond is called and therefore only held until the first call date. That means that the yield to call for a discount bond will be higher than the yield to maturity, and the yield to call on a premium bond will be lower than the yield to maturity. When a bond is issued, the coupon rate on the bond is set at a level that is comparable to the market's interest rate at that time. If the yield that is demanded by the market is the same as the bond's coupon rate, then the bond will sell in the market at par value. When the bond is trading in the secondary market, its price will change based on the current interest rate market. Assume that the bond has a 5.5% coupon rate. As long as market yields for this type of bond are at 5.5%, the dollar price will be par. But what happens if interest rates rise in general? Assume that interest rates rise to 6%. This bond yields only 5.5% if it's priced at par. To be competitive with the market, the price of the bond must drop to a level where this bond yields 6% to match the market interest rates. Therefore, when interest rates rise, the prices of bonds trading in the secondary market must drop. For a discount bond, the yields, in order from lowest to highest, are nominal yield, current yield, yield to maturity, and yield to call. Yield to maturity and yield to call always assume that the bondholder is holding the bond as long as they can, which is until maturity or until it's called. Regulations say that between those two yields, the worst yield must be the one quoted to potential investors. For a discount bond, the worst of the two yields is the yield to maturity, since it's lower than the yield to call. On the other hand, what happens if interest rates fall? Assume that interest rates in general fall to 5%. A bond that is yielding 5.5% when priced at par will move up in price to make the yield comparable to current market rates. To be competitive with the market, the price of the bond will rise to a level where this bond yields 5%. Therefore, when interest rates fall, the prices of bonds trading in the secondary market must rise. The yields from lowest to highest for premium bonds are the opposite from discount and are yield to call, yield to maturity, current yield, and the nominal yield would be the highest. Remember the rule of quoting yield to worst. In most cases, for a premium bond, that would be yield to call, but in circumstances where the call premium is high, the yield to maturity may be lower than the yield to call, making the yield to maturity the worst of the two yields and the yield that must be quoted.